Welcome to Turtle Talk. Dive into the fascinating world of timeless trend-following strategies and the pursuit of the elusive outliers made legendary by the turtle traders. Join your hosts, Adam and Rich, alongside our esteemed co-host, Jerry Parker, as we uncover the powerful principles of classic trend following. From counterintuitive practices to the mechanics behind capturing market outliers, each episode offers a masterclass in navigating the financial markets. Expect in-depth discussions, expert insights, and actionable advice to help you master the art and science of diversified systematic trend following, turtle style. Tune in every month as we explore the dynamic and ever-evolving world of trend following, equipping traders and enthusiasts with the tools to succeed. And now, without further ado, let's hand it over to your hosts, Adam, Rich, and Jerry.
Welcome back to Turtle Talk. It's Sunday, the 30th of November, 2025. This is episode 9, and it's great to have you all with us. I'm joined, as always, by my partner in crime, Adam Havryliv, and of course, the one and only Jerry Parker. So, Adam, where are you today?
Beautiful Kuala Lumpur, where the weather is mild, surprisingly mild for KL. And
no cyclones about?
No, it's all pretty good. There has been a little bit of wind and a little bit of rain, but it's very, very comfortable here at the moment.
Very nice. And Jerry, so you've recently come back from a Hedge Nordic event in Sweden. And you've also recently had your Thanksgiving, where there's obviously a lot less turkeys now in the US than there was before. So how are you going?
Going great. We love Thanksgiving holiday here, and a lot of food and turkey, football games, and relax. It's nice to end the week kind of on Wednesday, and then, of course, Thursday's a holiday, and no one's really doing too much on Friday. So it's nice to have a short week and long weekend. It's kind of chilly here in Tampa this morning in the 40s, 50s Fahrenheit. So I'm not used to that. I was all bundled up this morning walking the dogs. And, but, you know, Sweden is a very cold place. I stayed in the Ice Hotel. We spent the night in a hotel room made of ice. And obviously very cold. And the bed was made of ice.
Actually made of ice?
Yes. Look it up on the internet, Ice Hotel. Very wonderful place. Highly recommended it. A lot of fun. We saw the Northern Lights. Had some, we fed the moose, we fed the reindeer, and we ate the reindeer.
Oh, my goodness.
Yeah. Not the same ones. Not the same ones. No, not Rudolph. And also my first time having moose. So all good. It was really fun. Nice people. Sweden's a great place. Stockholm's wonderful. Great place to visit. Great place to live. I'm sure it's just marvelous. I like everything about it, and it was nice to get away from the warm weather of Florida and see some cold weather for a while. Yeah. Then we saw some snow, nice snow. The wife loves the snow. Oh my gosh!
So I don't know if this is a silly question, but how do they keep you warm if everything's made out of ice?
You sleep in a very warm sleeping bag, and you're sleeping on top of some animal skins, you know, and so you don't feel the ice bed. And we weren't cold. We thought about doing it 2 nights in a row, but one night was plenty, and then we went back to the normal heated rooms and normal accommodations. But
Gotcha.
It's a fun place, and if you look it up, you'll see each room has lots of carvings and statues and furniture, and it's like artwork. It's like a museum almost of sculptures, and fascinating. Next year, we're thinking about going to a place called the Tree House, where all the rooms are up in the trees.
Goodness me. Well, that'll be a lot.
That's right. Yeah, that sounds amazing. And I think, Jerry, you really exemplify savoring the trend. I think you're really maximizing this trend-following lifestyle.
Always.
All right, gents. Well, Today we've got a full show lined up. We will start with Battle of the Trend Indexes, where we discuss the state of trend following as at the end of October 2025. Then we'll move into what's moved the needle, and there we look at the big charts that are playing out at the moment. And then we are running an extended Titbit session this month with a number of deep dives into some very important topics. And after that, we'll answer your questions in Shell Mail. So there's no spotlight segment this week, but let's jump in. So over to you, Adam, for the Battle of the Trend following indexes.
Okay, so I'm over at classictrendindex.com, and I'm looking at the October numbers, 1.63%, and we're back in the black for calendar year 2025. So hooray for that. We're up 30 basis points for the year. And God, that's actually quite a lot of work, isn't it? Just to get 30 basis points out of the calendar year. And but it's good to be back in the black, I think, after the wobble in, I guess that started in February, and we had a few red months, February, March, April, and May. And then we've had a pretty good recovery, and back in the black. I was looking at some seasonality statistics, and November, December, January do look pretty good for trend following. I was struggling to get a p-value under 0.05, but I think one of those months actually did have a 0.055, so almost statistically significant seasonality. Was actually doing that on our own back test, so I'm not really sure exactly how we potentially we could run that over some indices going further back in time and have a look at that. But I digress slightly. If we go to the more, I guess, longer term performance here, I'm seeing that we're looking pretty good over the last 12 months and 2 years. And that's trend following more broadly, but in particular, the classic trend index. So I see, month to month returns and volatility, I don't think are something that we should get too hung up on, but it's nice to see our index outperforming over the last quarter, the last 12 months, and the last 2 years. And then obviously since January 2020. So, over to AussieTurtles.com website, you can track us under the ClassicTrendIndex.com tab, and you can compare the performance of our three managers, Chesapeake, Tuckahee, and East Coast Capital Management, aggregated in this index. Certainly outperforming our peers. Richard and Jerry, do you have any thoughts or comments?
It's interesting that one of the topics that I'll be bringing up today will give an explanation for why there is this divergence between this classic trend index, which I'm referring to as Outlier Hunter Index, versus the rest of the trend following indexes that have probably higher Sharpe, less, exploit less convexity. And in that, we'll see why in particular regimes, we accelerate away from the rest of the group that have a higher Sharpe in those particular regimes. I'll give an explanation for this divergence that we've seen since 2020 to 2025. Which I'm thinking has been a very positive regime in general for our particular class of models, the outlier hunting models. But JP, anything to talk about here?
I think it's interesting that our index only contains 3 traders, three funds, and so that's interesting. And I think from what I understand is that we're the three different managers are fairly different. We all have the same philosophy of letting profits run and having loose pants, classic trend, but probably the entries and exits are different. And we trade a lot of stocks and a lot of markets. and Takahi trades some spread trading and their version of long-term trend. So I think we're getting a lot of diversification in how to approach the markets. Similar philosophy or almost the same philosophy, but we're getting some diversification, even though it's only three different managers.
It definitely there definitely is a benefit of combining a few of these products together when it comes to I guess they all have to be well performing and underlying programs, which in this case they certainly are. But you do still get a benefit in terms of improving the Sharpe ratio, Sortino ratio, and the MAR. Because, as you say, Jerry, even though the philosophy is similar, the implementation is certainly different in terms of underlying portfolio and the exact trading strategies that are implemented.
And the markets are different.
Absolutely. Well, hopefully Santa brings a nice Christmas present for all the investors in these funds and trend followers more broadly. So I know that we had an okay November, and so hopefully December closes strongly, and we can end up in the black.
Be nice to get a good Christmas rally to sort of put us into the black, deeper into the black. It's been a tough year. The first half was tragic, but it's been sort of a slow crawl back from that April.
Well, kudos to those investors that have stuck with it. I think if you put the correction into historical context, it was material. It was a material drawdown. I think when we were talking about it, it was, some of those managers that had the biggest drawdowns that they had in 20 years or something like that. But this index certainly rode that out quite well. I mean, I'm not sure exactly what the drawdown here was, but
we've had a pretty quick recovery. That's the good snap.
It wasn't bigger than the gains made in 2024. So, I mean, 2024 was an excellent year, and I'm just sort of eyeballing that drawdown, and there's certainly no way that we gave up more than the gains that investors had in 2024. So I think sometimes you've just got to put these things in perspective, and obviously it's not nice to see red ink on the portfolio and balance sheet, but sometimes you just need to put this in perspective and keep executing the strategy, and now we're getting the fruits of that labor.
All right, gentlemen. So now let's move on to our next segment. What's moved the needle? So this is a quick reminder to listeners. This is our look at the standout charts of the month, and Jerry and Adam have shared their charts in advance to us. So we'll start with Jerry. Jerry, what's caught your eye in the charts this month?
Well, I think the two things the one big thing I wanted to mention was just how violent some of the sell-offs can be, and we've seen it in gold and silver. And then one of my charts was platinum, and there's been a couple of times since platinum broke out in the summer that it had $200 retracements, and then it made new highs the first time, and it's almost up to new highs now. So, and then also it really was even more violent in the cattle and the hogs. I'm sorry, the two cattle, feeder cattle and live cattle, where we're in the midst of a big drawdown, big violent drawdown in those two markets. But I think that trend is still intact because, hey, we run these systems and parameters through the back test, and it says have loose pants, be long term, And as painful as some of these give backs are, silver was a prime example as well. Violent sell-offs, lots of news, people getting nervous. So I'm just sort of saying I'm hanging in there with my cattle, even though it's sold off tremendously. It hasn't hit my exit yet, and my back test parameters are loose enough to still have my full position in those two markets, even though they may crap out and not end up making too much. But we have had a material give back, but I've not found anything in the research that improves this strategy other than being as long term as you possibly can stand, that makes sense, and that the numbers make sense. And so that's one of the things we just have to always remind ourselves, that no matter how bad it gets, as long as we're following the system, we're following our strategy that has a positive expectation and puts us in a high likelihood of winning in the end.
Well, Jerry, you've got really loose pants, and I guess that's why you're staying at the Ice Hotel and savoring the trend.
Yes. I mean, if I could trade shorter term, if I could trade 1 day shorter term and it worked better, I would do it in a heartbeat. It just doesn't work better. And we looked at our systems recently and did a big update on the most recent data, and it's saying, okay, you maybe want to get rid of your shortest term system and go a little bit longer term. So we would just love to not have to do that, but it seems that the markets are getting, maybe they're changing a bit to where we're going to have to keep looking at this over time, and the markets are kind of getting, I think, somewhat worse, kind of worse from a pure trend point of view. You would like to not have to have such loose pants, because that just means your drawdowns are going to be worse, and you're going to give back more profit when the drawdown is real, and it's going to get you flat to possibly short. So if anything else worked, I would be really happy to do it. But it's a lonely game sitting with these really choppy markets and really choppy trends.
Yeah, it's funny. We spend all this time looking at these price charts, but really we should be looking at back tests and parameter stability and boring and esoteric topics like that. But the charts are fun, and the charts do drive the daily P&L. I've got a chart of silver here, which I think, as at the time of printing this, was an all-time high on Friday night. So that's really, really exciting, and you should all have that in your portfolio if you're trend following correctly, as we do at ECCM. And interesting here, this other two charts I have: the S&P 500, obviously an equity index, and then the ASX 200. And we see here a big divergence, with the ASX 200 actually coming down and testing the 200-day moving average, and then sort of rallying above it. So that could be a pivot point for some people. So a trend follower
would be out of that trend. That'd be out of that long trend now for ASX.
Well, they may or may not. I mean, they might be using moving averages to get long above and potentially short below that moving average. But if you're using a breakout system, you might still be long because the price has not moved down enough for you to exit the trade or get short. So it all depends on how you're doing this. I have the moving averages there because it's easier to generate it on trading economics. I know that Jerry supplies his charts with the breakout channels, which is probably more reflective of our style of trading. But I think they're both, pretty good proxies for what's going on.
So the good thing is that dependent on the system you're using, they define trends differently. So let's say we were using a 200 SMA to exit these trends, you'd be out of ASX 200 and you'd still be in the S&P 500. And it really, each system you use defines trends differently. There is no one prescriptive definition that I see that works.
Yes, no, that's exactly right. And I think I was just, trying to draw the attention to the divergence between some markets. Our Australian market has been underperforming of late, and interest rates do seem to be going up here, maybe more so than other places around the world. And then one other really interesting chart here is the yield on the 10-year JGB. Now, Jerry provided the chart of the bond price, which obviously moves inverse with the yield. I don't have the bond price chart, but I've got the yield chart. The yields have gone to cycle highs here at a whopping 1.8%. So Jerry's doing well on that bond short, and I think we mentioned it earlier, and he said, "Well, I'm still short." And I said, "Well, of course you're still short, because you're trend following this market." And I'll throw a trick question at Jerry. I'll say, "What's your prediction on how high Japanese interest rates can go, Jerry?"
Well, I wouldn't really have a prediction. I don't really study the markets like that. And of course, the trend following strategy doesn't predict. But one point something sounds pretty low, doesn't it? So what a trade it would be if they got it up to 3 or 4. That would be pretty nice. That's another chart, too, that back in April, that chart is so violent. I'm pretty sure I set through that amazing rally. I mean, it was one of the biggest rallies of all time. But yeah, that was just pretty brutal. I think we sat through it and we were rewarded because it started the downtrend right after that, going right back down. But that's brutal. And I think that's the point I'm trying to make with the other two charts, the cattles. It's just not easy to sit through some of these trends. You really have to. And, one of the things too is don't think about this has the trend ended. I hear people talk about things like that. Well, I should probably get out of this trade because it looks like the trend has ended. I don't think that's helpful to talk about that. You should pay attention to the numbers. And sometimes the numbers and the parameters and the breakouts and the moving averages are going to look pretty silly because it certainly looks like the trend has ended. And I'm still in this trade. How is this? I have a problem with my system. I don't think you do. I think anytime you stray away from the numbers, which we have to do sometimes to have a podcast or talk to clients and explain to what we're doing, and trend following is a darn good explanation for what we're doing. But sometimes it looks like we're still long or short when the trend has reversed. And it's because we're following the rules derived from the back test. And I think that's what you want to really concentrate on, not whether the trend looks like it's ended. I'm still, and it looks like my position is incorrect. I need to fix that. I don't think you need to fix it.
Stick to the numbers. Stick to your predefined entry and exit levels.
Yep.
And enjoy the ride, I guess, to the extent that it is possible.
I don't think.
Sorry, JP, you go.
I don't usually enjoy the ride. I think I don't like that statement. I think it's silly, but I endure it, and I have no emotion about the ride. I'm not enjoying it. I'm not enjoying it. I'm just it has nothing to do with anything other than I'm just following these rules. And the more markets you trade, the less any one trade matters. You can sit there with a big sell-off, and it might be 50 basis points if you're trading 400 markets. It's really immaterial unless you get the big trade.
Yeah, our method is a very hard method, and you certainly don't enjoy the ride.
No,
but that's why the edge is so good, because that's exactly the ride that flouts the sort of the behavioural cognitive disposition of the human brain, and they can't handle it, and that's exactly why we do handle it, and it certainly works for our process. So,
and I don't want to enjoy the ride. I want it to be pain and suffering, and I want it to be hard to do. And because knowing me, if I get into this mode, Jerry, are you enjoying the ride? I am not enjoying the ride. Well, then fix it. Override the system. Create a system, alter your system and your parameters so you enjoy it more. And that's the road to ruin.
Exactly.
Is that why trend followers are always so cranky? Because they just wake up angry. They wake up angry every day.
No, no, I don't wake up angry. Not every day. Maybe sometimes. It's not anger
Not
either.
every day.
It's like, I don't get angry at the
I don't wake up
markets.
angry every day. Just Monday, Tuesday, Wednesday, Thursday, and Friday.
No.
All right, well, thanks for the charts, gents. So now let's move to the big segment for today, Turtle Tidbits. So, Adam, over to you.
Yes, Turtle Tidbits. Let me lead off this segment. Richard, you have got topic number 1. And may we ask you why outlier hunters excel across the full cycle?
Okay, Adam. So this particular topic looks at why outlier hunters tend to win across full cycles. Now, what I'm talking about is long periods of time, decades of both smooth regimes, rough regimes. That's what I'm terming the full cycle. And the idea came from a discussion actually Jerry was having on X, where someone, we won't name the person, argued that a higher Sharpe system could outperform long-term trend followers simply by adding more leverage. So I've heard that many times before, and I need to discuss it now because the nuance is important. So I put together a post on the ATS website this week, which I'll show the figures on the screen so listeners can read the full piece if they want to get into the details. But if you look at the first chart in that piece, this refers to the chart arising from what I call the calm world. You can see in this instance, in a calm environment, a calm regime, why the claim that many people make feels convincing. So in calm regimes, the higher Sharpe model performs beautifully. It's smooth, stable, and efficient. And the metrics line up with that impression. So in the chart, when you look at the chart reflecting this calm regime, the chart shows a hypothetical smooth market cycle with very few outliers. And it reflects a type of regime that dominated, for instance, after the GFC and carried through up to 2020. People refer to that as the decade winter of CTAs. So I need to now explain the chart. And so when you look at the chart, you'll notice that there are 4 equity curves presented on it. And the lowest 2 curves represent the outlier hunting technique. And you'll notice that the green curve represents an outlier hunters program, and the curve above that is that outliers hunters program, which has had 2 times leverage applied to it. Now, the higher 2 equity curves represent the Sharpe model, the high Sharpe model, where the lower equity curve represents a Sharpe model that has fairly low positive skew, but it's dynamic position sizing, volatility targeting, all of these things that we don't like to produce this smooth ride, the higher Sharpe model. Now, when you leverage that up in this smooth regime, it appears very good. You get a very good result out of that. So now let's look at the metrics associated with that chart. So the Sharpe model has lower positive skew than the outlier model. And it has a much higher Sharpe. But when we look at the CAGR is the important thing here because the CAGR reflects the geometry of the path. And this is the clearest guide. Sharpe doesn't tell us about the path of returns, CAGR does. So with this high Sharpe model, when we apply leverage, the penalty to the compound annual growth rate or CAGR in calm conditions is small. The compounding drag that occurs with increased leverage exists, but it's not large enough to erase the benefit of that smooth profile. So in these steady environments, you can absolutely outperform an outlier hunter by scaling up a higher Sharpe system. In calm conditions, that approach works. Now, here's the rub. The problem is that calm conditions never last. Eventually, the world shifts, and when it does, the entire logic that I've just explained flips. And this is where the geometry of the path takes over and KGAR becomes the dominant force. So let's now move into a hypothetical scenario called rough world. So in this regime, this is an example of a regime that we've been experiencing, for instance, from 2020 up to 2025. It's a regime that we are looking at for Battle of the Trend following indexes. This is what I'm calling rough world, not smooth world, which was the decade before. This is rough world. So when we look at the chart, I'll bring up the charts here. Once again, we've got 4 equity curves, but the lowest 2 equity curves are the higher Sharpe models. Now, what is important here in rough world is that the lowest equity curve is actually the leveraged Sharpe solution, higher Sharpe solution. The second lowest chart is the unleveraged solution. The 2 higher charts represent the outlier hunters equity curve in rough world, where we get a very good positive geometry in the compounded path and a high KGAR with the green line. And when we leverage that up, like going towards Mulvaney stakes in rough world, we get a massive explosion in KGAR. That's how the chart should be read. So this is where the whole idea breaks down. So leverage, applying leverage, is completely agnostic to direction. It amplifies the good and the bad equally. So, but compounding does not treat gains and losses equally. A large loss reduces future wealth far more than an equal size gain can rebuild it. And that is the geometry underlying every return path in terms of its geometric profile. So once volatility snaps, correlations collapse, and losses begin to cluster in rough world, the high Sharpe model gets punished. And the leverage version gets more punished, even harder. So there is no positive convexity in the smooth model to offset that damage. The system reduces exposure at the wrong times. They're for instance, reducing position size in the cocoa trade when they should be keeping constant with their position size. So they're getting no positive convexity in the smooth model to offset that damage from the volatility drag with higher leverage. The system reduces exposure at the wrong times, and the right tail winners that are needed to repair the profile, they never arrive with enough size because they're always tampering with those beneficial trends. The downside, therefore, overwhelms the upside because the upside is capped by design in those smooth, high Sharpe models. And therefore, let's look at the metrics. So when we look at the metrics, we see that the Sharpe model now, in this particular rough world regime, has negative skew. Losses dominate the geometry, and the rare gains in rough world, because they're not exploiting those gains, they're not large enough to repair the damage. This is the effect of suppressing upside in order to preserve smoothness. So in the rough regime, Sharpe actually turns negative for the smooth model, and the KGAR is a real kicker because without leverage, it's already strongly negative because of unfavorable compounding geometry, but add leverage and the result becomes more crippling. But now compare that with our outlier hunting model in that same rough regime. The difference is clear on the chart. The convex model benefits from volatility. The upside expands faster than the downside decays, and leverage improves KGAR instead of destroying it. And this happens because the lower Sharpe model of our outlier hunting models has strongly positive skew. It produces outsized winners that more than compensate for those losses. And the smooth model simply does not have that property. And this is convexity in action. So the metrics reinforce the point because When we let profits run without constraint, we capture every opportunity from beneficial volatility. This more than compensates for the volatility drag that comes from cutting losses short. Our skew becomes strongly positive, much higher than the smooth model. Even our Sharpe is higher in this regime, although Sharpe is not the story here. The story is the geometry of the CAGR, and in the rough regime, it dominates. When we lever this model up, CAGR increases sharply because the large winners carry the entire path forward. The system survives, adapts, and hunts outliers that extend the right tail while strictly containing the left tail. So now let's look at the full regime where we stitch both smooth and rough world together. Who wins the battle of CAGR? Once we stitch the calm and rough periods together into a full cycle chart, the story becomes obvious. Smooth systems might win the calm decade, but when we look at the chart now over this full hypothetical market cycle of both smooth and rough, we see that the CTA, the outlier hunting model, significantly outperforms the smooth model. Outlier hunters win the turbulent decade, but they might lose the smooth decade. But only the outlier hunter wins the full cycle, because compounding is not determined by average behaviour. It's shaped by a handful of giant winners and by the avoidance of catastrophic losses. Sharpe measures this smoothness. CAGR measures wealth, and the world rewards wealth, not smoothness. So when we look at the full cycle metrics, the outlier model wins the CAGR race because the benefits of the rough regime more than compensate for the reduced returns during calm periods. So the moral of this story is simple. You cannot fix the missing outliers of a smooth system by adding leverage. Leverage does not create large winners. It only magnifies a structure that already exists. If a system does not contain convexity, leverage will not give it convexity. In rough regimes, it simply magnifies compounding drag and breaks the path of geometry. Outlier hunters succeed not because they predict the future, but because we prepare for futures that cannot be predicted. They endure the quiet years, they thrive in volatile years, and they stay exposed long enough for rare events to rewrite the entire equity curve. And this is why convexity matters. This is why CAGR matters, and this is why outlier hunters win across full cycles. So there you go. Any comments, gentlemen?
Well, that was a pretty good rundown there, Rich, and you certainly do have a lot of content over at ATS Trading Solutions. I was browsing through that article as you spoke. I think this whole issue of volatility and the optimal, quote unquote optimal volatility. I'm not sure exactly what the answer to that is. But yeah, I think we just have to accept that this strategy does not necessarily have the highest Sharpe ratio, but it's got an underlying robustness that even the most volatile events that you can throw at it won't destroy it. So it's certainly where I allocate my capital, and I think it sort of makes your portfolio more robust.
Yeah.
And less dependent on that calm outcome that you described.
JP, anything to add?
Well, I think I'm looking forward to watching this play out over a number of years in the future, and so that our index continues to outperform and do well, and maybe we'll get some recognition from people who prefer higher Sharpe ratios.
Yeah, this is the problem I've got is when we use the term optimization, which a lot of the industry does, they're optimizing for things. Now, the problem with that is that optimization refers to a static past. refers to a static past. How do you optimize based on what history is presented? And this is where the problem lies. We don't optimize for anything. What we're doing is we've created a structure that allows convexity to do its thing. So what we're saying is we're not predicting anything, but we've simply got a structure that is asymmetric, truncates the left tail, allows right tail opportunity to explode. That's it. That's our simple, robust methodology that we can put into any environment. Yeah, we might have a difficult time over smooth regimes where Sharpe models and optimized models that are beautifully targeted for that smooth regime do well. But we don't care about that because we know that the future could be significantly different to what's happened in the past. We've simply got a process and a model that adapts and exploits convexity. That's what we're doing. And that's why we're going to win in the long term. It's not about predicting.
It's funny you mentioned smooth regimes, and I don't know why it just came to me, but all this talk of volatility laundering, I think which has been popularized by Clifford Asness. And, it's the ultimate calm regime con job, really. Let's take these risky assets, let's lock them up for 10 years and, mark them with no volatility for the period. And what's interesting at the moment is we're seeing this realization that they're either going to be worth what was written on the tin, or potentially written down by some material amount, and all of a sudden that calm regime is actually not so calm after all, because you're not getting back, you're not getting the dollar back that you were promised, whereas we accept the volatility on a daily or weekly or monthly basis, depending on how you mark the strategy. But you really are seeing the risk in the strategy without it being tucked away and hidden, which may well cause some big problems for some investors over the coming quarters.
Yeah, I'd like to move on to this next topic now, because someone might say, "Oh, but how do you know we're not going to get extended smooth regimes in the future?" Well, we don't. And yes, that means that our models might not perform as well as some of the other models. But history, long data sets, tells a different story. It says that we ain't seen nothing yet. And I just want to go into this next topic to explain what history tells us about how smooth or rough these regimes are. So what this topic is the title is 125 Years of Crisis. What markets really do. So this next one is a journey through 125 years of US equity market history. And when you look at that much data in a continuous sweep, you start to see patterns that are invisible inside a normal trading career. So those big shocks that feel very rare to us are not actually rare at all. They are part of the rhythm of the system. So whilst we use the term outliers, perhaps that's an anomaly. They're not outliers or anomalies. They are part of the structure, and this goes into it. So most traders think of crisis events as rare interruptions in an otherwise stable world. The language even reinforces this belief. We speak of crashes, panics, shocks, as if they sit outside the normal behaviour of markets. A trading career of, say, 20 or 30 years strengthens this impression because only a few dramatic events appear within those short horizons. But when looking at more history, we find that markets drift quietly for long periods of time, smooth world, and then something shifts. A regime turns, liquidity thins, pressure builds in the structure, and what looks chaotic in the moment, with the panics and the crashes, actually becomes incredibly patterned when you zoom out far enough. And these are going to blow your socks off. I've got some charts and figures to look at here. So the system, when looking over large data sets, behaves like something alive rather than something mechanical. So to uncover that pattern, We've examined two expressions of the market stress across this 125 years of history. We've looked at daily returns, which capture the short-term form of stress, and we looked at drawdowns, which capture the long form of stress. Daily returns show how the system reacts when it's hit suddenly, liquidity slips, order flow becomes one-sided, and the crowd reacts in hours. These are the sharp pulses of reflexive behaviour. They tell us how violent the system can be over the short window. Drawdowns, however, reveal the slow mechanics of stress and strain. They show how tension accumulates across days, weeks, months. They show volatility clusters. They show correlations shift. They show leverage unwinds. And they show waves of liquidation moving through the network. Drawdowns tell us how the system absorbs pressure, then releases it all at once when something snaps. So you need both lenses, the daily lens and the drawdown lens. Daily returns show the pulses of these shocks. Drawdowns show the deeper geometry. Only when you combine them can you understand how crises form and how they spread and why they repeat across generations. So before we look at the visuals, here is a simple methodology behind the behaviour. So we stitched together a continuous daily record from 1907 to today. The early decades come from the Dow, the later decades from the S&P 500, to compare events like 1929, 1987, 2008 and 2020. So we express every move in sigma terms using a 1% daily volatility baseline. It gives us a common language across a century of different structures and different rules. So then we measure two things for each major event: how likely it should have been under a Gaussian model and how often it actually occurred. So let's start with, I'll put table 1 up on the screen. So with this table, here are the most violent one-day declines over the past 125 years. The panic of 1907, Black Monday, multiple waves of the Great Depression, the GFC, and the COVID shock. Now look at the sigma column in that table. So in a Gaussian world, these events should not happen at all. But in the real world, they show up again and again. Now, what feels shocking in a short career, that's why we think these are rare events, looks entirely normal across 125 years of history. Tail events are not anomalies, they're part of the market structure. Now, to see that, and this is very impressive, this is a graph of these events plotted onto a log chart. So this is a log scale plot comparing the Gaussian tail with the empirical tail of daily returns from our table. So the dashed Gaussian curve collapses almost immediately. According to that curve, everything beyond 6 or 7 sigma events belongs in fantasy land. It assumes the world is gentle and predictable. But look at the actual empirical curve. It drops slowly. So it stretches across the entire range of crisis events, and every event from table 1 sits right on that heavy-tailed line. It's almost a straight line. It's not a curve. This is a signature of a complex adaptive system, not a neat probabilistic model. Markets behave like a living organism under pressure. They store tension quietly, then release it suddenly. The system does not forget, and it does not soften with time. It produces large events because that is part of the design. So now let's shift to the long-term form of stress represented by drawdowns and bring up table 2. Daily shocks show the sharp edges, but drawdowns, however, show the full path of strain. And here are the major peak to trough collapses over that 125-year period. We've got a minus 48% drawdown in 1907, a minus 86% in the Great Depression, a minus 57% in the GFC, a minus 34% in COVID. Now, also remember NASDAQ in, I think it was 2000, I think I had a 90% decline. But anyway, now look at the Gaussian expected drawdown. It sits at 5% for all of them. So what I've done is I've plotted graphically a Gaussian drawdown versus the empirical drawdowns. And according to Gaussian theory, these collapses should be shallow and rare. But the table or the graph and shows the reality. Prolonged, deep prolonged drawdowns driven by liquidity waves, forced selling, leverage unwind, the reflexive dynamics that build on themselves. These are not statistical accidents. This is rough world. This is rough world where we exploit opportunity with our models. These are the system expressing its internal tension. It's structural. It's not an anomaly. So the Gaussian line is flat at 5%. It barely moves. The empirical drawdowns sit far higher above it and across the full range. The pattern climbs cleanly, decade after decade. This chart tells a very simple story. Markets absorb stress slowly and release it suddenly. They hold tension in silence, in calm world, and then everything unwinds together. Rough world. Drawdowns reveal a real geometry of stress. It clusters, it cascades, and it repeats. Now, when you combine all the visuals that I've presented in this topic, 8 clear insights fall out naturally. Extremes grow as the sample expands. This is contrary to Gaussian assumptions, where with a greater sample size we converge towards the average. That is not reality. Extremes are dominating the story here, not the averages. Your worst drawdown is therefore always ahead of you because the sample size increases ahead of you. As is the greatest opportunity with our models is always ahead of us as the sample size increases. This explains why the worst drawdown is always ahead of you. This is the structure of markets. It also tells you that volatility behaves like a regime, not a number. It tells us that feedback creates fat tails. It tells us that sequence matters more than averages. It tells us that risk comes from inside the system, endogenous, rather than exogenous in source. It tells us that structure overwrites probability, a handful of extreme events shape decades, and Gaussian comfort has nothing to do with reality. So it leaves us with this simple message. The market is not a stable machine. It's a living system. Crisis is not an interruption. Crisis is how the system breathes. This is why trend followers survive, because the edge sits in the tails, not in the middle. So that's a story told by 125 years of data. The next big drawdown and the next big opportunity are still ahead of us. That's not a prediction. It's how this kind of system behaves. It also explains why models that have not changed significantly over the last 30 years from our camp, the outlier hunting structural geometrical model, is experiencing its best returns now, 30 years later, without over-optimizing, without overfitting. It's all about the fact that a rough world is part of the structural fabric of these markets. And the Gaussian world, unfortunately, the world that so many have drifted to, the world where they say that diversification runs out after a certain level of number. They're saying the marginal benefit of diversification ends according to the square root of sample size. Well, this totally contradicts that. It says no matter how much sample size you've got, maximal diversification is the way to go because the structures are always bigger ahead of you. There's so many things in these models that it's telling us. And it's just telling us that the world and orthodoxy has got it so wrong. So over to you guys.
Well, it's a great article, and it's a great collection of statistics. I don't know if you collect statistics like anecdotes, but what I love about trend following is that it's not a guarantee, but so often trend followers are on the right side of those big moves, exactly because, as you describe, the feedback mechanisms, Richard, and clustering of returns. It is no accident that trend followers thrive and profit quite often in those market scenarios, and it's almost like we're looking forward to the next big crisis or boom or bust cycle, because that's when we really do shine. So, notwithstanding that we can't necessarily predict or profit from any one individual day or months of performance, as these trends and dislocations evolve, these trend following systems do seem to be on the right side of those major market moves. And you would have seen a few of those in your trading lifetime, Jerry, wouldn't you?
Yes, enough to make me very confident that that's the way to approach the markets. I was telling Mike the other day that
Mike Melicino.
Yeah, on the podcast, I mentioned on the podcast that isn't it interesting that three out of five classic trend followers we know about, three of us, Moritz and Mike, the three of us are accountants. Mike's an accountant too. So not only
losing, Jerry. I hate losing.
Yeah, I hate losing, and I love the small losses, and it's almost like if you have your bankroll under control with the small losses, and you're not risking too much, and you're not using the open trade equity as part of your sizing, then you can hold on to those winners and deal with the ups and downs and the profit givebacks of the winning trades so much better, from a risk control point of view, for people who really are conservative by nature. We're trading these futures markets, we're letting profits run, we're having all this volatility. You would think we're just big gamblers and people who love risk and don't pay attention to the problems of risking too much. But it's quite the opposite. This whole strategy is built around those two important facts of letting the profits run and taking small losses. And realizing this is something that's popped up over the years. It's gotten worse. Where I always like to say that from our point of view, when platinum retraces and the cattle goes down, like we did in the first segment about the charts, these are not losses. A loss is the small loss. These are profit givebacks. It's much different. Much different. Our philosophy handles them much different. I'm willing to lose 50 basis points per trade if it's a losing trade, and hundreds of basis points if it's a winning trade from the peak. So that's the formula. It's difficult. It doesn't make sense sometimes, but that's what's worked over all these years.
And Rich, your analysis, it doesn't just have to be bear markets or crisis events, because exactly. I follow a website, Current Market Valuation, that puts the valuation on the US stock market as basically being one of the most extreme, in the history of US markets. And they do a composite index, and it's coming out at 2 standard deviations above the mean for valuation, and they're predicting based on that, negative returns into the future. But how would one actually use this information? Because presumably at 1 standard deviation above the mean, you were already bearish. So did you take some long trades off the table? Did you look at shorting? What happened at 1.5 times standard deviation? And now at 2, how can you actually use that information? And then on the flip side, the trend follower actually has been long those markets into those arguably overvalued markets. Time will tell whether the AI revolution delivers or not. But the flexibility to basically participate in these unknown and extreme moves, whether they're bullish or bearish, I think is the beauty of the trend following methodology and approach.
Yeah, the thing is, it's not. This is why we have such low correlation to the dominant models that exist in the universe of financial markets. The buy and hold, long-only model or the 60-40 model or whatever, we have almost no correlation with them over the long term. Now, the way I see these financial markets work over 125 years, I've only looked at the downside here, and Adam, you're right. If I looked at the upside events as well, we're going to get a similar story from them. But what you find is that when everyone starts doing the same thing, the market loses diversity and it becomes weak. It becomes what I call fragile. If everyone's doing the same thing, if they're all, exploiting the AI boom or whatever, you'll actually find that markets become more fragile. And so when the tipping point occurs and we get the reflexive shock, we get the sharp pullback. That always happens. It's the way markets go from diverse to more and more fragile as everyone starts doing more and more of the same thing. Now, outlier hunters are sitting on the other side of that. We don't have this correlation property to what most people are doing. We've got a structural process here that ensures we are working with the market structure. We're not responding to its growing fragility. So, this is why, when you look at the movies like Margin Call, Jeremy Irons says these events occur, every 20 years, every 30 years, without doubt. It's the way humans are geared. It's the way people start following the gravy train. The market's becoming more fragile, then they reset. Markets become more fragile, then they reset. Markets become more fragile, reset. Gaussian statistics and models don't pick this up. But this is a market that remembers. This is a market with structure. This is a market with geometry. This is a market where things cluster. Memory works. What happens to your bank account 100 days ago matters to what happens today. All of these path-dependent, memory-based features is what is creating this continually again and again.
Well, indeed, I think trend followers build systems around what markets truly do and not what the theory wishes they would. Thank you, Richard. Now, we've got a topic here provided by Mr. Parker. Jerry, diversification versus outlier hunting. Why trend followers play a different game? Can you talk to that topic, please?
Yes, sir. I will do that. I just think we've said this before, and Rich was hitting on it earlier, but I think it's important to remember that the trend follower doesn't look at diversification the same way as a traditional portfolio, where in a traditional portfolio, maybe you will make the decision, it would be a good decision that you don't need to keep adding markets if you'll get maximum diversification with 10 or 20 or 30 different positions or sectors, and incrementally each market that you add offers less and less diversification and reason for adding. So, but from our point of view, since we're hunting the outliers, we take a different perspective on that. And at the same time that CTAs usually have more diversification than any other strategy: currencies, commodities, stocks, bonds, long, short, crypto, even maybe. And I would say that the outlier hunter is doing that. He's appreciative of the diversification and that you get from those markets and some robust diversification and smoothness. I think adding markets is better than adding parameters to your system. So it's a risk-free way of smoothing things out a bit. But the outlier hunter will also trade London coffee and New York coffee, and London LME copper and New York copper, and crude, West Texas and Brent. And these are markets that are 95% correlated all the time, because recognizing that even two markets like that, where they're most of the time very correlated, one of those two could have an outlier move when the other one did not. And so that's what we're really we're changing the rules on the diversification through not so much smoothness, although we appreciate the smoothness we get. It's more like we're hunting more outliers and knowing that it is possible to get trends in markets that are highly correlated. Market A might be a big outlier, and market B may not be. The very first big turtle trade in 1984 was February heating oil, and it was not January and not March. It was February only. So here you have crude doesn't do anything, and unleaded doesn't do anything, but then you have just one specific month of heating oil, and it was because the harbor in New York where they bring the heating oil in was all frozen over, and they couldn't get it in. And so I think that's a really good example of just because it has a similar name or it has historically a high correlation, it doesn't mean that you won't get an outlier. And then trading more and more markets, you'll have your risk budget, and true, you will reduce the size of each individual market to stay underneath that risk budget. So one of the big benefits of trading more and more markets from a classic trend point of view is the minimization of bad luck and increasing your chance that every year you'll have some outliers in every year, and people who trade 21 markets or 65 markets or whatever have a higher chance of having longer periods of time where they don't really make money.
Yeah, that's really interesting. You mentioned this. Is there a more diversified strategy? I mean, I sort of challenge anybody to really describe a more diversified strategy than systematic trend following. If you have one, send us an email so that we can consider it, and not consider it like to trade it. I'm talking like just consider it, because I just don't even know if there is a more diversified strategy. And then, on this correlation of markets topic, Jerry, I think right now we're seeing some really interesting things in the energy complex. And, so we're trading a whole lot of energy products. And, Jerry, I'm sure you are too. And Rich, you would appreciate this given your scientific background. They're all sort of like related in a chemical sense, because they're distillates of, an underlying commodity being oil. And so they should be related. And, as the price of one, the underlying goes up, then, it's logical to conclude that the distillate moves up in the same direction. But actually, we're seeing a divergence. We're seeing crude oil prices go down, but we're seeing distillates go up. And your sort of basic economic theory, it doesn't really explain it. But then when you look at some of the things that are happening in energy markets, with supply coming on and off the market, and very tight refining capacity, it's setting us up potentially for some very interesting dynamics in those markets. So
you've heard of the butterfly effect. A very small butterfly flapping its wings in Brazil potentially causes a hurricane, say in Australia. Well,
are you saying a bug has fallen into a vat of oil somewhere?
No, what I'm saying, here's an example. We've got Brent oil, we've got crude oil. Okay, two similar markets which are correlated over their entire cycles. Now, what I'm talking about is the outliers and why they are uncorrelated. All we need in one of those examples is a thinning of liquidity of one of them. And let's say we had these markets with high average liquidity, and we got 100,000 traders all impacting in the same way into those markets. We get a certain result. Crude oil goes up a certain price, say 2%. Brent oil goes up another price, let's say 1.5% to 2%. Similar, correlated. However, let's thin the liquidity of the market now. Make one less liquid than the other. This is just one of the dynamics that affect these feedback loops and the butterfly effect and these things. When you thin the liquidity, you'll find that the same number of people are involved, but one is now pushing up the price 15%, while the other, with higher liquidity, is still around the 2%, the 3%. This is because the dynamics, the structure, the complex adaptive system, what the agents are doing and the structure and the geometry is affecting these outliers. So when people are talking about correlations, they're tending to say, well, over the entire market data, they're correlated. However, when we look at the outliers alone, they are very uncorrelated with each other because each outlier is unique. Now, our models are only being activated when we think, our systems tell us, that there is a possibility for a material outlier. They're not active over the entire history where it says they're correlated. So that's why we don't worry about trading these highly correlated markets. It means nothing to us. We're worried about the structure. We're worried about the things that create these outliers, which are unique tsunamis. They're not correlated features. So it's a no-brainer to us.
Yes, I think if your risk budget... Go ahead, Jerry.
One thing I left out was, when you trade, when you have these big trends like gold and silver, for instance, and you're trading multiple systems, what sort of correlation do you want between your different systems? You want 100% correlation. You want to be long gold and silver in all of your systems. So I think that, and when all the markets are going up, like in 2020, when the commodities did real well, all the commodities were going up, but some of them went up a lot more than the others. And so another thing about trading lots of different markets is that you start to realize that it's not so much that you're willing to accept the high correlation sometimes because the profit and loss in each individual trade can be so different. Soybeans went up a lot in 2020, but bean oil made a lot more money. And so you can convince yourself, well, soybeans and bean oil are going to have the same basic move. Yeah, true. But one may be a tremendous outlier and the other one may not. If you're a DPS CTA, scaling back your positions all the time, the big trends due to correlation and or volatility, then it's not going to matter as much trading soybeans and bean oil, because if you have bean oil in the portfolio, you're going to be scaling it back. It's going to start looking more like soybeans anyways. So once again, if you're not doing the classic trend following thing, hunting the outliers, letting them having unbounded possibilities in those markets and not taking positions off before the trend turns around and before your trend following exits kick in, then maybe you can get away with trading a 20 markets, 60 markets. But things are going to get a lot better the more markets you trade. We trade a lot of stocks as well. So we're not only buying silver and gold, we're buying the miners. We're not only doing heating oil at the breakout, we're doing oil companies and companies that drill. So we're getting some of that. We're getting a lot of diversification too. Sometimes the stocks do much better than the underlying commodity. Sometimes they do a bit worse. So you never really know. It's a different animal, and it's trend following, not managed futures. So we're not subject to trading. We're not subject to trading futures only. Trend following is too big. It's too powerful to be limited to futures.
Here, Mr. Speaker.
Well, it's a very, very interesting approach you are bringing to the table there, Jerry. And I think that leads us to my final comment here. And I have got the topic and I think it's a very good segue from what we've been talking about, is trend following an infinite money glitch? And, you would think that based on this conversation and the previous podcasts, yes, it is, but the question is the point is, what makes this strategy so enduring? Is it a glitch? It's not a glitch. It's one of the few investment approaches whose robustness has been proven repeatedly across geographies, asset classes, and decades of markets environments. And it persists not because the markets are broken, but because human behavior and market structure are remarkably consistent over time. And so when people look from the outside and they see the long-term results and the huge compounding of returns, as Jerry has experienced over his career, they see 40 years of CTAs or trend followers, more correctly, capturing market dislocations. And they assume that something supernatural is happening. But if you actually run these models day to day, you realize that performance doesn't come from a trick or a hidden hack. It actually comes from discipline, a rules-based approach to absorbing lots of small losses while staying open to the possibility of very large gains. And what those people aren't seeing is the long stretches where the strategy is simply grinding away, following the rules through the noise, uncertainty, and sometimes, yes, difficult drawdowns. And that's exactly where the edge lies, in being systematically willing to do something that is emotionally very hard for discretionary traders. Trend following works because a market exhibits persistent behavioral biases and structural features. Participants are crowding around the same themes. They're anchoring to prior information. They're underreacting and then overreacting, panicking in groups. Those behavioral dynamics don't simply change because technology advances or because algorithms are involved. If anything, the presence of more systematic players reinforces the conditions that create trends in the first place. Is that why we're not worried about competition, Jerry and Rich? More trend followers actually makes bigger trends? It's an interesting question, isn't it? So it's definitely not an infinite money glitch. It's a rational, disciplined way to navigate uncertainty. We're cutting losses to protect capital. That's non-negotiable. We're letting winners run because we are targeting these large outliers that disproportionately drive long-term returns. And we're diversifying as widely as possible across markets because, as Jerry says, we don't know where the next big trend will come from. And then, of course, we're sizing those positions systematically and carefully because risk management is the foundation of everything we do. The irony is that the simplicity of the rules makes the strategy look easy from the outside. But I think, as we've discussed here, to execute those rules consistently in real time through all kinds of market conditions is the struggle, right? And that's why the edge persists. So no, it is not an infinite money glitch. The reality is far more grounded. Trend following is durable because it aligns with how markets actually behave and not how we wish they do. So as long as humans continue to make decisions under uncertainty, I think the core logic behind trend following will continue to be relevant for a very long time.
It reminds me of a tweet I saw recently where Cliff Asness said, something with a 0.2 Sharpe ratio is not really worth going after and arbing it down to zero. So I think our Sharpe ratio is higher than 0.2. It's probably 0.4 or 0.5. But I still think that is it's not that high. I think not having a high Sharpe ratio is kind of something that protects us to some degree from, and I think when people over the years have said trend following doesn't work, that's what they've sort of meant to say, is that you think it still works with a 0.5 Sharpe? You're crazy. So I think that's what they kind of are saying, not that it doesn't work, but it doesn't meet their standards of what should happen and what is acceptable to them. So I think that's a good thing. We don't want the Sharpe to get too high to attract too many other people.
It's interesting, Jerry. Nigel Coolidge said that high Sharpe ratios are positively correlated with account blow-ups. That's right.
That's right. Exactly.
Yeah.
Yeah.
And that was great.
We're all doing this.
Perfection.
we're all doing the same thing, which is we are running one market in one system through the computer, and we're saying, oh, that's interesting. That market made money. And then we're saying, well, let's add more markets and let's add more systems. And so we get this results and we say, well, we can leverage this up some. And because we have so much diversification and the back test can justify, if we're only trading a couple of markets, we can't trade as large. But if we trade many markets and many different trend following systems, we can leverage up more and more. So it becomes critical of what are you leveraging up? Like you said in your earlier segment, what are you leveraging up? Are you leveraging up something that's suited for Sharpe world? Or are you leveraging up something that's suited for the real world? And you're going to get much different results.
Leverage is a two-edged sword of compounding. It can be beneficial and it can be horrific. And, if ever placed with the choice of, I've got additional capital, should I either increase position sizes or should I increase my levels of diversification? The logical choice is increase your levels of diversification with that additional capital, because all that leverage is doing is amplifying the good and amplifying the bad. That's all it's doing. It's not giving you anything about the geometry which you need to maximize wealth. That's what diversification, that's what our process is about. How to survive these markets with the best geometry. And when we place our computers to the test and we say, I want the most robust system with simple rules I can get across the biggest data sample I can find, universally applicable, ATR normalized. I don't want to put it just over 70 years of one market. I want to put it over 100 or 200 markets of 70 years history. So the computer chugs away with that simple riddle. How do I get the most robust system that produces the best optimal geometry path over this incredible sample size? This is what this 125 years of market data history was telling you. You get these massive structures. You don't know where they are, but they are there. And our models come out and say, hey, these are the best rules to apply when you're in that circumstance. That's why we apply these models and we don't let our brains interfere with our process. We follow what the computer says because it's gone through vast histories of sample size to come up with the most robust rules.
This is real red pill, blue pill stuff, isn't it, Jerry? Yeah. On one hand, you could have the leveraged private credit portfolio, right? And then on the other hand, you could have the sensibly leveraged classic trend following portfolio. I know which I would be taking.
All right, gents. Well, it's time to move on. It's been a long one so far, but we'll just finish off with some shell mail questions. So,
well, this is a long one, right? Because we're not doing the Christmas. We're taking a break over Christmas, aren't we, Rich?
That's a good point. I'll bring that up at the end, but that's a good point. Okay.
Oops.
No, it's all right, mate. Okay, so question 1 from Jason from Canada. He asks, he's got actually a 2-point question, so I'll answer this I'll mention this in its sections. Question 1. In your book, this is the Aussie Turtles Trend Following Guide, you mentioned that you can only exit when there is a tech failure or a catastrophic risk. Can you elaborate? And then his second question, which we'll discuss later, will Jerry collaborate on your second book? So let's get to the first question on Jerry's.
Did we say that? Did we actually say that, Richard?
Well, I think he's hoping, and so are we, actually, but we'll get to that one.
No, I'm talking about the first question.
Oh, the first question.
Not the Jerry's book question.
Okay, so I'll explain what we said in the book. So I'll start with this question 1. Okay, and then I'll give you guys a chance to jump in if you want to. So when we say we only exit in the case of a tech or catastrophic risk, what we're really saying is this. We exit only when something occurs that sits outside the scope of the system rules. In other words, an event that compromises the ability of the system to function as we designed it. So a tech failure is the clearest example. If the data feed breaks, if execution fails, if the platform freezes, or if the plumbing behind the strategy becomes unreliable, we step aside. So the system cannot interpret the structure if the environment it depends on is not working. And catastrophic risk is the second case. So these are the rare moments when market landscape functioning itself is impaired. Think of like exchange closures, liquidity evaporation, geopolitical events like world war.
Well, I know that a good example of that is when they suspended the trading in the Russian ruble.
Yeah.
So by law, you just were not able to continue trading the product. I think that's a very good concrete example.
Yeah.
Because we have glitches all the time. I know on Friday we had a glitch on CME, Globex, and markets went out for a little while, but that shouldn't really affect the trend follower. If markets are off for 8 hours, obviously depending on where they open, and in this case they opened very close to where they closed before the trading was suspended. That shouldn't really affect the trend follower. But if the exchange delists a product, obviously that would necessitate the exiting from that trade, right?
Jerry, thoughts?
Yes, I didn't know what exiting meant. I thought it meant exiting a trade.
I think
he's basically saying,
not applying the system, stepping aside from the system.
Yeah. So I think, that we've seen situations like that where volatility is really high, markets feel unstable, nickel maybe, and so it's okay to step aside, I suppose, sometimes, and especially
it's a very rare occurrence, though. I mean, Jerry, you would admit, could you count those on your one hand in your lifetime when you would have to intervene like that to do something?
Yeah.
And then when you did intervene, do you think it actually was a good intervention, or should you just stick to the system regardless?
I don't know. It depends on the situation. Oh, what happened after 1987 crash? No matter what you do there, you're just always wondering, I got to get back in here. I can't miss a trade. I mean, that's what's on your mind all the time is I can't miss an outlier. So
but surely your pants are not loose enough to stay long into the 87 crash.
No.
Loose, but not that loose. I remember, I think it was Harold De Beer. He was hit with was it the tin or the nickel debacle with the exchange, the London Metals Exchange?
Well, it was the nickel, and it was nickel just a few years ago, but it was just like people were pissed off.
Yeah.
Because some people exited a trade in nickel, and the exchange said those trades are no good, and nickel was a lot lower the next day. So it was a little unstable, and there were lawsuits and there were complaints. And
I think Clifford Asmus also got hit by that.
That's a good example. Yeah. I think that's an excellent example of confusion. If the exchange is doing arguably silly things and cancelling orders, I mean, it's very hard to play that game, isn't it?
Oh, yeah. Look, part 2 of Jason's question. So, will Jerry collaborate on the second book? So, I'll just give you guys a bit of context. We're planning another book, but for next year. But this one is very different from our first book, the Aussie Turtles Trend Following Guide. That was more about the mindset you need to become an outlier hunter. It laid the foundation. What's happening next year is a new book that's going to explain. It's far more practical. It's a detailed blueprint for an outlier hunter. So will Jerry be involved? Okay, Jerry, we're putting you on the spot here. Jerry's been a huge supporter of our Turtles project from day one, and his fingerprints are already over the philosophy behind what we teach. And if you know Jerry, you know he has a way of distilling complex ideas into very simple truths that hit you right between the eyes. That's what I've certainly found. So yes, we would love to have him involved in some way, whether it's a forward, a section, or a contribution to the framework we could all shape together. I'd love it. But over to you, Jerry. Are you interested?
Yes, always, of course. Well, we love to work with you guys and contribute in any way I can. So
perfect.
I look forward to it. Yeah.
Okay, we've got it recorded. So
good answer.
There we go. That's for next year. All right.
Yep.
Second question from Luca. When will the trend following playbook be available? Okay, so that's a second book. I mentioned next year. we're making strong progress currently, but these projects always take longer than expected, especially the editing, the editorial, the publishing process, etc. And also, we're continually tinkering with it around the edges, trying to get it to be a definitive guide for an outlier hunter. We've got to be very careful here because I know Jerry's going to read it closely and he's going to be pedantic for the exact details. So I've got to make sure it's correct. So it's going to be next year, probably maybe around November of next year, but that's going to be our playbook. That'll allow people to actually a strong practical guide to how you become an outlier hunter, the techniques behind it. Anything to add, Adam, there?
No, just that I agree with you, Rich. It does take a lot longer than one budgets or expects to produce high quality content like our first book, which I recommend you purchase if you do not already have a copy.
Nice plug, Adam. Okay, question 3.
Good Christmas reading, actually.
Yeah, mate, it's very good Christmas reading.
That would make a very good Christmas present,
wouldn't it?
For anybody aspiring to trend follow.
All right, question 3 from Slav Z. We've had Slav put in numerous questions before, but here it goes. This is for Jerry. All right, Jerry. How does shorting equities 1-to-1 fit inside a portfolio built on positive skew? Not sure what he's asking there, but you might be able to know what he's talking about.
Well, I'm going to guess that what he's talking about is the longs are a lot more profitable than the shorts. And so we all know this. We all know that almost all the money is made by the longs over our career, over the whole history. But the shorts are pretty good at stabilizing the portfolio. They can make money sometimes when the longs are not doing well. And they offer great diversification. And they're not losers. So we've had some good shorts on this whole year. And one of the things I think is important, why it's so important to trade individual stocks and have individual stocks in your portfolio, and like a good trend follower, go long those stocks, go short those stocks, just like all the other markets. Anybody who trades or a trend follower who trades and has different rules, you know exactly what to do with those stocks. It's the same thing you do with everything else. But most people struggle with that idea. They've been brainwashed that stocks are so much different. Everything's different, but make it fit into the trend following world and trend following framework. And true, the shorts don't go down as much as the longs go up. That's true in all the markets. But one of the most important things about trading these stocks is you want to come into April short, which we did. We had shorts on when all hell broke loose in April because we traded individual stocks. And there's always going to be stocks in a downtrend, regardless of what the overall S&P is doing. And so now we have about 60% of our stocks are long and 30% are shorts. We have a substantial S&P because it's going to hit all-time highs next week, maybe. And we're going to have, and there's 30% of the stocks are in downtrends. Embrace it. Love it. It's wonderful. No, if you trade the indices, you're long all of them. Maybe you're short one, but you're probably not. Maybe you're flat a few. But you're coming in with a much riskier position because you have no shorts on. Optimally, you want to have longs and shorts in each individual sector. We don't have much of that in the currencies now. We're pretty long. Maybe we're long and short in the interest rates. Commodities are a little bit better, but stocks are usually the best at if you have a broad portfolio of stocks that you're trading, you're going to get some different chart patterns and some longs and shorts all the time.
Adam, anything to add?
No, I'm sort of focused on coming into December. I know liquidity can thin out as we get closer to the end of the year and the first couple of weeks of January. So that always has my antenna up because I don't want to have any problems with with execution. I know this sort of can happen once or twice a year where there's a little bit of a gap in the market, and they go for some stops. So I'm just sort of focused on making sure all the order types and liquidity issues are being managed over that period. I think apart from that, I'm just looking for a nice quiet close to the end of the year. I don't know if we'll get it.
Nice Christmas.
There's a bit going on at the moment.
Yeah, Jerry's already had his Thanksgiving. He's already having the fun part, so we'll get there sooner or later. All right, gents, that brings us to the close of episode 9. So, no other comments, gentlemen? I think we're done and dusted for this episode. It was a big episode because, as I'll tell the viewers shortly, we're not going to be having a December episode. We're going to take a well-earned break. So this was a mammoth episode today to make up for all of that. So I hope our viewers are happy there. But anything more to add, guys?
No. A lot of good information. I'm saving it for the next book.
Yeah, perfect. All right.
I'm going to go find a fancy restaurant in Kuala Lumpur and I might go and do a savouring the trend.
Oh, now that sounds good. All right.
So stay tuned, and I know I owe some people some savouring the trends as well.
Yes, good point.
So we got Michael Covell up there on the website, and that's a great read, and because he's always just such a fun guy to catch up with and just give you the unfiltered raw view of the world. Which we love.
Yes,
we love Michael for. Yes, that's right. We did eat porcupine because when in Saigon, you do what you have to do. And I know, Richard, you ate a duck embryo. I mean, it's crazy.
Oh yeah,
it's a crazy place.
Jerry talked about his ice castles where he goes. We've got our food experience we can talk about.
So yeah, we've got a savouring the trend with Niels Kastrup-Larsen to publish, and then of course Jerry savouring the trend from New York. I have not forgotten. I have the notes.
That's where we snuck into his flat and destroyed. Had a big party in there.
That's right. And then I might get one in here while I'm in KL. But apart from that, I guess it's may the trend be with you.
Yeah, it's been a great year, guys. It's a pleasure sharing it with both of you. It's been a great year.
Yes.
All right, so looking ahead, our next podcast will therefore be at the end of January. So we hope all of our listeners enjoy the festive season and have a great one. We wish you all a Merry Christmas and a great New Year. And thanks for all your support, your messages, and your enthusiasm for the work we're doing here. But join us at the end of January for episode 10, where we continue our journey. We may have a guest joining us for the Spotlight session next month, and so look forward to that. So keep an eye out for that. But until then, stay systematic, stay patient, and may the trend be with you.
Thanks for tuning into Turtle Talk. If you enjoyed the episode, don't forget to rate and review the podcast. It really helps us reach more listeners. Share it with your friends and invite them to join the conversation. Got a question for us? Send it to info@aussieturtles.com, and we'll do our best to feature it on a future episode. Please note, Turtle Talk is for informational and educational purposes only. The views expressed by the hosts and guests are their own, and do not necessarily reflect the opinions of the podcast producers or affiliates. This podcast does not provide financial, investment, or professional advice. Always consult with a qualified professional before making investment decisions. That's it for today, folks. See you next time, and as always, may the trend be with you. Thanks for tuning into Turtle Talk. If you enjoy